Today, we're going to examine where the U.S. is to some degree, and the difference that we're seeing, which is rather profound, between hard statistics, meaning the actual performance of the economy in its various sectors, and sentiment indicators, which have been uniformly buoyant since the election back in November. Now, what do I mean by the difference between these two? The hard numbers are the numbers that we're used to examining when we talk about the economy. The GDP numbers, industrial production numbers, retail sales numbers, from all sectors of the economy, how the economy is actually doing. What people, it's one thing when people and consumers say, as they have, judging by the sentiment indicators, that they're very expect things to get better. They expect jobs, they expect income, they expect to be able to do more in the years ahead. That's one set of statistics, and it's very understandable. After all, an election is a pivot point, often in policies and sometimes in actual performance. So whatever portion of the country, a little slightly less than 50%, voted for Mr. Trump, they didn't do so because they wanted things to get worse. They hope that things will get better. And they're expecting, at least hoping, that Mr. Trump will be able to make some changes in the economy that produce jobs, income, and such. Now, this type of thing is possible. Certainly happened under the presidency of Ronald Reagan, although the pain, should be noted, came first and was actually started by Paul Volcker, who was appointed by Jimmy Carter, the prior president. But nonetheless, that is portrayed, and rightfully so, I think, as a result of Ronald Reagan's policies, economic and otherwise. So the possibility is certainly there, as it is based on historical precedent. These things have happened before. What we're going to look at is whether or not, at first, the background, whether or not the situation, economic and otherwise, is analogous. I think it's probably not, but we shall see. So, first of all, this is, let's take a look at some of the indicators that we're all used to dealing with. And as always, if you have any comments or criticisms, I always ask for jokes. I never get any. I'm still hoping. Just type them into the chat on the FX Street Forex Live video channel. And just be patient. I monitor it periodically, and I'll be glad to stop and answer any questions that you have, but don't ask me for sports indications and or opinions on Hollywood movies, because I did not watch the Oscars last night, so I have not a whole lot of interest in that kind of stuff, to tell you the truth. Okay. Although I hear they made some sort of massive faux pas over the Best Picture announcement or something like that. Anyway, this is a chart of the 2-year. Probably the most sensitive of the Treasury issuances to economic policy, but also to the immediate prospect for rate changes in the Fed. And what does this chart show us? Well, we know what this is back here. It's back in November. So this chart is showing us a bump, an expectation from the election, and very little else. The 10-year, I believe I have the 10-year here. Yes, I do. Looks, guess what? The same. No surprise there. Neither one of these charts, if the credit markets, which are the most, in my mind, which are obviously the most reliable of the markets in predictions, There's that old line from the Clinton administration. If I got to choose what I came back as after dying, I would come back as the bond market. Mr. Clinton could be kind of funny, actually. Ex-President Clinton. So neither one of these charts is showing the acceleration that you might expect if you only looked at the sentiment numbers, consumer sentiment numbers, say the ISM numbers. Yeah, so the ISM numbers, the Purchasing Managers Index, they're semi-hard, semi-not, because they include orders, new orders which come through, and that's a hard number. If you're a purchasing manager and you're seeing a great deal more business starting to come in, you have a substantial basis for an optimistic viewpoint. Consumers, less so. Consumers are disposed, I believe, to being optimistic. After all, what does optimism for consumer means? Well, it means, we're going to get more money. We're going to get pay raises finally. We're going to be able to spend more, be able to do more for our children, whatever it is we'd like to do. Take more vacations, whatever it is, however you choose to spend your money, that will be something that, and so there is a bias, I believe anyway, that there is a bias, an upward bias, an optimistic bias in the consumer numbers, consumer sentiment numbers, as there is an upward bias in the stock market as well. Part of the stock market bias, of course, is simply because the economy grows, it gets bigger, there are more people, and that produces a higher index average. Okay. So neither one of these indicators, I'm using the two interest rates, the 2-year and the 10-year, which are the most commercially important rates, is showing a positive. As a matter of fact, at the moment, let's look at the 2. I would say that it would not take much, considering where we are in the 2-year, which is 1.1567. That was this morning, just before I came in, to engage the rate pessimists. This is an optimist yield rally. It's not based on anything substantive. It's based on perception of a candidate and a campaign. And we're still there, because what has happened through this period here is basically nothing of substance economically. President Trump has been focused on other issues. He's put out a lot of, by the way, the U.S. State of the Union address is tomorrow. It's going to be, no doubt, a raucous affair. I will say one thing, Mr. Trump seems to have brought back the type of politics in the United States that was common in the 19th century, maybe even the early part of the 19th century, where the opposing sides did not, shall we say, spare the rhetoric, spare the accusations, or spare the behavior. We had, I think, a rather and what you'd never believe here in the United States or anywhere else, that this particular type of political conflict, better than a military conflict, is played out, is so much worse than it's been before. This is simply not true. U.S. politics was far more enlivened, shall we say, in the 19th century than it is now. We've actually seen a long period of relative civility in politics. It does seem, however, that Mr. Trump is doing his bit, along with his opponents in the Democratic Party and elsewhere, the progressives, to end that period of civility, which I don't think can cause any particular great harm. At any rate, so this chart is telling you this chart has become a sentiment chart for this period here. This is the 2-year. As with the 10-year, they're now, until something happens, they're sentiment charts. Rates went higher. One, we know the Fed wants to raise rates. Okay. But the rates are so low now that it's not at all possible for a long-term prediction. What would happen? The way the Fed normally works, and the Fed is another indicator here, which is on our topic, are we facing, or as I put it, what did I say here? Balance sheet recessions are historically followed by a long period of anemic growth. That's what we've just had. But the question that remains is, have we altered, or has it altered, the underlying rate of growth in the United States? Over time, on an economy as large as the United States, a difference of 1% in average growth over a period, 5 years or 10 years, is an enormous difference in absolute amounts, in income, in spending, in social mobility, in social satisfaction. So it's not that, well, 1%, 2%, 3%, what's the difference? There's a huge, huge difference. Mr. Trump has said he would like to get 3% growth. At no year in the Obama administration, 8 years, what did U.S. growth ever reach 3% for 1 year? That, I believe, is the first time that's ever happened in modern history. I mean, after the Second World War, I believe it's actually the first time it's ever happened. But that can't possibly include the years of the Depression, so I'm not sure. But certainly in modern history, post-World War II, that has never happened. That's a rather dismal achievement, but we shall see if Mr. Trump will do any better. I mean, one of the other differences here is it's certainly conceivable that the recession, the financial crash, rapidly precipitated the United States and the rest of the world, we're going to talk about that in a second, to a situation of low growth which had long been building. That the average growth rate in the United States, a mature economy, along with Germany and others, has changed as the population changes, as regulation change. That's one argument, that you have a structural change in the US. If you want to tie it to something, you can tie it to the aging of the population. And that we're now in an era of 2% run rate growth. That's one argument. That's the structural argument. The opposing argument is that the policies of the Obama administration were growth inhibitory, that their emphasis was on regulation and other issues and not on economic growth. And they did very, very few of the things that were necessary or that have worked in the past to promote economic growth. They were heavy on the regulation, which is certainly not something that will promote growth. Some of their environmental policies, I not pass judgment on, I'm just saying that their effect on the economy was inhibitory. And I don't think there's any argument about that. Whether that is the cause or it's structural is something we're going to find out. It's one of the things that Donald Trump was elected to discover. But as far as what is being viewed now from the markets, we're looking right in front of us. This is just as, let's see if I have that chart here. By the way, my charting system was down when I walked in this morning. And I do apologize, but that's why most of these charts are slightly out of date. I could not pull up any new ones this morning. I called our provider and they had not called me back at the time of the webinar, so I apologize. But luckily I had a bunch of charts from prior. Okay, so let's look here. I have some charts here which are useful, I think. Okay, this is, oops, let me put it up. Okay, so let's look, well, let's do this first. Do I not have any? Unfortunately, I do not have the chart I'm looking for, so we're gonna have to use something else. Okay, let's do this way. This is going to have to be my substitute for sentiment charts. Okay, we know what this is. This is the Dow. Now remember, as with the interest rate charts with the 2-year and the 10-year we just looked at, this is right now a sentiment chart. The economy is still growing at 2% a year. It was before the election, and it is after the election. The first GDP numbers out of Q4 were 1.9%. I have a prediction here that they're going to go up to 2.2%, and all I can say to that is big deal. This isn't any particular change. Now, is it too soon for any effects of whatever particular policy Mr. Trump is going to put through? And we're going to talk about that in a second. Of course it is. But there is no material alteration in numbers, in the hard numbers coming out of the U.S. economy. We just had the Fed minutes, and it was the standard story for the past year and a half, year and a little more. But talking about it for the past 2 years, we've had 2 rate increases, right? Each in December, 125 basis point increase per year. Now, does this speak to anyone of hard numbers, of numbers that are showing an accelerating economy? Yes, we have had some return in inflation, but nothing else. So this rally from November 8th or November 9th, right there, is a sentiment rally. There's nothing behind it. There's only hope and expectation and momentum. And still a profoundly low interest rate, which has not changed. Whatever you want to say about the Fed's policies, and I'm not trying to angle this one way or the other, they are not predicting robust growth. They've managed a 0.5 point increase in 2 years. They know sooner or later there's going to be another recession. I mean, the laws of economics and the business cycle has not been repealed by anybody. And the Fed profoundly does not want to be in a position with a 0.5 to 0.75% Fed funds target rate when the next recession hits. They'd rather be at 3%. How they're going to get there? I don't know. They're raising rates 0.25% a year. Well, that's 4 years. Let's say 4 years. So that's another 8 years before the Fed gets rates to 2.75%. Is this a prediction of robust growth? No, of course it is not. Not only that, the Fed's own predictions over the past 8 years have been routinely wrong. Too optimistic, too soon. They've had to revise them every single year. I don't see any reason why this year will be any different. Plus, this sentiment rally, as with the yield rally, if you want to call it that, in the 2-year and the 10-year, is based on the most unstable of economic indicators. And what would that be? Politics. Politics. Mr. Trump has said that he wants to do many things. He wants to do tax relief. He wants to reduce the corporate tax rate. Will that over time produce money coming back in jobs? Yes, it probably will. But two things I think are true about this, and let's talk about the politics of this for a second. Because there is no proof. You know, we're at a position where 8 years after a major financial crash, brought on by what? Well, among several other factors, low interest rates. Speculative, there's, you know, if you blame speculative excess, this is, in my mind, nonsense. Markets always speculate. That's what they do. And guess what else they do? They always speculate excessively. That is what markets do. For the people who got out of oil at 140, they made a ton of money. Unless they went long at 138, I suppose. So the lure of this type of trading behavior, of market behavior, is not something that's going to change. It is part of its DNA. And so the idea that it's speculating excessively, well, who's to say? I, for one, have never bought these arguments. What's more important, if you're talking about that, is what are the economic factors behind it? And I don't mean the profit motive. I mean the facilitation. Oil was a great example of that. That market was, and that price was facilitated, one, by cheap money, and two, by structural changes in the oil market, which permitted a great deal more people to participate. And what do traders do? Well, they go with the trend. Why should it be otherwise? How should it be otherwise? So back to our Dow chart. This is a sentiment indicator. Let's take a look at another chart to show you something a little different. Okay, this is wrong chart. Hold on. Okay, this is the Shanghai Composite. Now, I'm not choosing this to show that these are comparable. They're not. But what are we not seeing here? We're not seeing a substantial rally here from late 2016 into 2017. We are not seeing that. So we know, and this is true of other markets as well, that the US stock market rally is something which is national. I suppose, since Trump's essentially a nationalist politician, that's appropriate. But the economy is global. Now, since the financial crash, comparative judgments between economies have pretty much been the worst of a bad bunch, meaning nobody's doing well, nobody's doing great, doesn't look like anybody's going to do great. So when you're looking for a place to invest and speculate, you simply put your money, or your opinion, in my case, in the market that's doing the best out of the bunch. And that has been, for almost the past decade, the United States. So that remains as portrayed in this particular chart. Where's my Dow? Okay. Okay. So let us see if we can come to some conclusions from some of the statistics that we're looking at, and then make some sort of judgment about why we're looking at this. Okay. So just about what's going to happen right now. We have, in about 2 weeks, in one of the most, I won't say overwrought, but overwatched statistics in the past 10 years, and that, of course, is the Fed funds rate. I mean, everybody focuses on this, and basically nothing happens. This chart, the 2-year, bring it up again, is absolutely not predicting a rate cycle. The Fed is in, and its judgment of the economy is what we're talking about, of course, is not in a rate cycle. This is not a rate cycle. As I just went through, it's going to take, at the Fed's current rate of increase, it's going to take till the end of the Trump administration, if he gets reelected, to get rates back to 2.75%, the Fed funds rate, somewhere along the historical level. Now, if the US growth rate, average growth rate, is actually 2% or even lower, then the Fed funds rate is going to be lower too. So we may not get back, and this is, no one knows, we may not get back to the historical, even if you only use the past 20 years, historical level of the Fed funds rate. But this is not telling us that there is a rate cycle in the cards. So the Fed rate and the Fed FOMC meeting, which will be on the 14th, I believe the 14th and the 15th, is kind of irrelevant. I mean, the Fed could look at this. The only thing that is predicting a potential Fed increase in March, and I don't think they're going to, they're going to wait till June, is this. This is the CPI. Now, I know everybody knows the Fed watches personal consumption expenditures, which is lower. But that is a very rapid rise in the inflation rate. Expectations haven't changed. Expectations are still relatively low. And this is the annual rate, so there is some base effect here. But that's a rapid rise. And it's not only the overall rate. And after all, I've always thought that the Fed use of core rates is inefficient. They are supposedly looking at expectations which they think will only be affected over the longest term, and not by month-to-month or week-to-week changes, or even half-year-to-half-year changes in prices brought on by rapid changes in primarily energy prices, which of course have been brought on by Fed policy, but that's another story entirely. But the actual retail sales, consumption in the economy, decisions made by the largest number and by everyone in the economy, business or individual, are based on CPI. I was out in the market over the weekend, actually last Friday, buying some short ribs for jjigae. We do a lot of Korean cooking in my house. And I was amazed at how expensive. I don't usually shop. My wife usually does the shopping. And I was amazed how expensive short ribs were per pound here in the United States, or in New York, or actually New Jersey. Short ribs are not a terribly expensive cut of meat. And I was amazed how expensive they were. And so I asked my wife, is this normal? And she said, yes. Food prices have gotten much, much higher over the past 2 years. Now, this is something that the Fed purports to ignore by excluding food prices from the inflation numbers that they say are important, and that's why I've never bought it. Because if food and energy is higher or lower, it affects real economic decisions by real economic actors in the economy, primarily business and individuals. The Fed will say, well, people don't worry about this, but I don't think that's necessarily true. In addition, it changes or can change their actual, at the moment, spending decisions. The ECB looks at overall inflation, which I think is far more sensible. It's always been my contention that the Fed's policy of core inflation is sort of a self-serving statistic, an outlook, probably based 30 and 40 years ago when inflation was a great threat. And so there was a bureaucratic urge to make the reported numbers lower. And one of the ways of doing that, in addition, they've done other things, also change the CPI statistics and what's included so that less inflation is included, up to relate to the core value rather than the overall value. But be that as it may. I don't have the PCE numbers here, but I do have the core numbers. I do know what the PCE numbers were. Okay, so this is, so you can see the difference in the charts. It's quite interesting. This is core CPI. It's calculated along different lines than the core PCE numbers, but they're essentially the same, except one is lower. There hasn't been a great deal of change. This is an interesting chart. From the beginning of 2016, the core CPI numbers have basically varied 2.3 to 2.1. There's, except for this move here in the fall of, in the last 2 quarters of 2015, core CPI has been stable. Look at the difference here. CPI. Remember, from the beginning of 2016 on, core CPI has only varied up and down 0.2 of a point, from 2.3 to 2.1 and back. In that same period, overall inflation has gone up 1.7%, from 0.8 to 2.5. One of these is right. And the Fed, of course, says, well, core is right. But the point being, for the economy, for retail spending, is that while we have this not quite about half a year right now, a little more, jump in inflation, there's been no real change in wages. This is the worst of all possible worlds for the Fed and for interest rates. The Fed can look at inflation, and if this continues for another 6 months, they should probably do something about it. But there's a huge lag for interest rate policy. But this is the worst of all possible worlds. You have rising inflation and stagnant growth. There is a word for that. It's an infelicitous word, stagflation. But if you get too many more quarters of 2.5 or higher CPI, I don't care what the PCE is doing, with 2% economic growth, then you are verging on stagflation. It is possible, although we haven't seen it in 4 years, that The enormous amount of liquidity created by the Fed is finally creating inflation. That Milton Friedman will end up being justified if at a delay. But there's certainly no conclusion based on this. But if you look at this, and especially the 2% growth and the 2.3%, I believe annual wages were 2.3%, and the same with personal income. If you look at those numbers, then how does the Fed raise rates at anything more than the current pacing? And look, if Fed has now projected back in December 2 rate increases, okay, 2 rate increases a year. We're having the time, okay? That's 0.5% a year, 1% every 2 years. So we're talking 4 years now to 2.75% in the Fed funds rate. Does anyone really think we're not going to have a recession in the next 4 years? Nobody seems to know, and I don't know myself. But neither one, either 1%, 1 rate increase a year or 2, is going to get us anywhere soon. So if the Fed is not confident enough in the economy, and frankly sees no signs of it, how do you justify increasing the pace of rate increases when the economy is growing 2% a year and wages are barely matching inflation? There is nowhere to find acceleration. You can't find it from business because businesses are not going to invest substantially, and they have some reason to do so. So we know where this leads. What do they do with their money? Well, they buy back stocks. Well, what does that do? That drives up the stock market. What else does that do? Nothing. Simply gets a higher level of stock markets. So the Fed's own policy predictions are not telling you what their rhetoric has been telling you for 4 years now. Economy's getting better. Fairly soon, we're going to start raising rates. Yes, sir, we're going to. When? I don't know, maybe twice a year. I mean, so the Fed is telling you flat out 2 things. You got a choice, okay? Either there has been a structural evolution in the U.S. economy, and there are economists out there saying that 2% is the new run rate for the United States. Well, this is a profoundly different world. 2% essentially means the ability of people in the United States, particularly those without large investments, which is most people, who depend on salaries and wage income for their improvements in living standards and their children's, are not going to see now any substantial improvements because the economy is not growing fast enough to generate more wealth. So if that's the case, then it has profound political implications, the first of which was this year in the election of Donald Trump, because what we're talking about here is a profound class differentiator here in the United States. In the past, since the Second World War, economic growth provided an increase in living standards for almost all people here. Not all people, but almost all people, all economic classes here in the United States. I remember distinctly when my parents bought their first second car. what a big deal this was. For most of my, how old was I then? Oh, probably early in high school. For all my childhood, we'd only had one car, and everybody we knew pretty much only had one car. And then we bought two. Clearly, there was more money available, and not just for us, but for everybody. We perceived it as such as children. Now, my own family, my brothers and my sisters, have done better than my parents. There's more money, different things, but the sense of progress is one that is lived, evidenced in your own life. And this is something which has been profoundly important to the United States' and American citizens' concept of the country in themselves. And what seems to be happening now is this progress is becoming narrower. It is becoming restricted to a smaller group of people. And that other groups of people are not experiencing this, are falling in areas of the country. This sort of economic, how shall I put this? Economic division, not a great word, but the best one I came up with, is one of the things behind the election of Donald Trump. There's no question about it. It's called populism, as if populism is something evil. Aren't all elections about populism? But anyway, and just so you know, and we do not discuss politics on this show specifically. Oh, by the way, I should let everyone know. I'm going to be starting a weekly interview show for FX Street in conjunction with FX Street and Worldwide Markets. And we will be interviewing, I will be interviewing all sorts of market makers and people from across the spectrum of are involved in the markets, from technical analysis to economists to traders to psychologists. We'll be doing this once a week on Wednesday. I think it'll be interesting. We're going to start with half an hour, and then we will move on. We'll be doing it live, of course, and then you can look at the, if you're so inclined, you can watch the videos if you can't make them. They'll be posted on the FX Street site and on our site as well. Okay, enough self-promotion there. I'll be doing more of that. So this, I just want to warn everybody, whatever your political persuasion, if you are trying to analyze the effect of politics, or in this particular case, the potential effect of DC politics, i.e. the Trump administration and its coming economic policies on the US economy, beware of the US media. Please read outside what you are getting out of the United States, or at least vary what you're reading within the United States. Some of Mr. Trump's complaints about the media are over the top, but many of them are actually based in fact. This is just a warning, not based on policy, but so that you will be able to successfully analyze the likely effect. Remember, this is one very large group of analysts right here. This is analysis right here. But you'd never know it if you only listened to the political analysis largely coming out of the media in DC, New York, and LA. You would have no conception of why the stock market would go up. So beware that. Make sure you read all around. Okay, enough admonitions on that topic. My purpose is to make sure that everybody gets the best information. Okay, so let us return to our topic. What are we? Well, the basic topic is, has the U.S. economy shifted into a lower growth mode permanently? Or are we seeing the long run residue of a balance sheet financial crisis, which is what we had? Everybody went broke, basically, which takes a long time. That's the Reinhard Rogoff thesis. There's economic proof for it going back, I think they go back a couple hundred years. Abetted, of course, by the non-pro-growth policies of the Obama administration. And regardless of whether they were justified or not, I have no opinion on that I'm going to express here. But they were not the type of policies that were likely to promote economic growth. Okay, that's just a fact. You can accept it or not. So you have a potentially, there are basically three possibilities here. One, you have a financial recession, and nothing that any administration is going to do is going to change that. You have a 10-year run out. We're getting to the end of that period. Low growth because the economy still has not recovered, essentially. Two, you have an economy that would have recovered much quicker, except for the inhibitory policies or the non-growth policies of the Obama administration. That's one possibility. We don't know. And the third is that the U.S. economy was both shocked and evolving into a lower growth state. That may be true as well. We don't know. Most likely it's a combination of everything. Who knows? So those are the possibilities. Well, now we have a change. Mrs. Clinton, who would have continued the policies of the Obama administration, has not been elected. Mr. Trump was. The stock market is telling you that it is anticipating a change in policy. Now, the stock market is biased towards optimism, okay? But it is telling you that if the first two are true, to whatever degree that they mix and match, then a change in economic policy will have a beneficial effect. Now remember, regardless of this, let's take a look here. This is just a slight lesson in markets. Okay, this is the run-up from the financial crash. That entire period, we're talking 2% growth. Nothing in 2% growth justifies economically a more than doubling in the stock market value. Did the U.S. economy double in size? No. Did home prices double? No. Did wages double? No. So, I mean, all of these things are not true. There's not a real lot of economic basis for a stock market level. When I did this, it was 2357. It's now 20,700 or so. But that doesn't necessarily mean that once things return to normal, whatever that means, and one of the things that we're looking at, of course, is we don't know what normal is anymore. We don't know if it was a balance sheet recession. We don't know if it was largely because the Obama administration was essentially non-growth. We don't know if the U.S. economy has permanently changed to a 2% economy. We don't know. We may find out. So if the U.S. economy does go, just say in 2018, grows 3% or 3.5%, does that mean that the stock market will not change because the economic rationale is now catching up to the level? No, of course not. What it means is that it's going to do this. It's going to continue to boom. The market does not, and no market cares whether its level makes economic sense. So the market is not going to wait till the economic justification catches up to its level and then move higher. If the U.S. economy in the second half of 2017 starts looking like it's going to grow faster, the Dow is going to continue to go up. Just keep that in mind. Markets are not interested in economic rationality unless they have to be. So just keep that in mind. Okay. There's another issue here, of course, and I'll just touch on it briefly. So we'll just look through some of the numbers we're seeing. We don't really have a lot of numbers out. We have now, one thing that's good is consumer confidence, another soft number, very high. ISM manufacturing, another semi-soft number, very positive. Real numbers, construction spending, not impressive. Personal income, not impressive. Personal spending, not impressive. Non-manufacturing ISM, impressive. So the durable goods orders for January, except for aircraft orders, civilian aircraft, not impressive. Shipments, not impressive. Core goods, the GDP component, not impressive. So again, we're seeing this real split. It doesn't matter to the stock market, but we're still seeing there has been very little or no, and it's much too soon for it. But keep it in mind. The Fed is not going to raise rates based on optimistic consumer sentiment numbers or on ISM numbers. The Fed's going to raise rates on real numbers. At least I hope so. So we don't yet have an answer, nor are we going to for another 6 months. So what are some of the things that could derail the optimism, which is still in abeyance, or the numbers supporting are in abeyance? I mean, the Trump administration hasn't done anything yet, and nor should we expect them to, about Obamacare. There are economic arguments that Obamacare, or it's known the Affordable Care Act, a great example of bureaucratic nomenclature if I've ever heard one, has been negative for growth. I'm not going to enter into the argument, but there have been coherent arguments that that's the case. So will its repeal help? Could be, if it gets repealed. Regulatory changes, will that help? Certainly could, but nothing has happened yet. Tax reform, tax cuts, corporate tax cuts, will that help? It certainly could. It's certainly conceivable that it will promote economic growth, but nothing's happened yet. And you aren't, even if and these are very complicated things. And from a political point of view, the one thing the Republicans cannot afford to do, because they will then lose power again, is to produce a substitute healthcare plan that doesn't make things better, at least somewhat. Improve access, bring costs down. If they don't do that, they're in trouble politically. And they certainly know that. The dissatisfaction with the Affordable Care Act has been one of the drivers of the loss of political power across the board by the Democrats over the past 6 years. There's no question about that. Anyone who makes an argument otherwise is simply presenting a point of view. Since the passage of the Affordable Care Act, the Democrats have gotten politically wrecked at all levels of the United States government. So is there a connection? Absolutely. So all of these things are difficult to do. So it's my guess that you're not going to see any substantive changes in the policies that I've spoken about for at least 6 months. And that means there isn't going to be any economic result for probably a year. So can the economy just tool along as let's say, reflected in the Dow level? It certainly can. Will it? I don't know. There are many things out there that are problems. Okay, so to answer the question that was posed at this webinar, do we have an answer? Unfortunately, we don't. But the things we need to keep in mind are the substantive changes in the US economy are going to take a long time. They're going to take a year or more before we start to see anything as far as hard numbers go. That in that time, there are potentials out there which could easily, potential events, which could easily undermine the economic confidence represented by the equity levels. Certainly the credit markets are undecided, shall we say. They're certainly not agnostic, but they're undecided. What are some of these things that are possible? Well, there's an election next month in Holland. There is an election in France in the spring and in the summer. There's a potential election in Italy. There is an election in Germany. There are all sorts of things. World economic growth, including the United States, is weak. Besides the simple fact of the statistics and what they reflect, we are in the 8th year of an economic recovery. It would not take, there has not been a lot of wealth generated. There's not a lot of leeway in the global or the US economy. So it would not take a great deal to undermine what conditional optimism there is in the world. There is the potential Scottish vote, and I'll say a little bit about that. The party running Scotland, the Scottish National Party, wants independence. They lost the last time 55 to 45. Things have changed substantially since then. I believe it's necessary for the Westminster government of Theresa May. That was great. I was telling my, talking with my girls last night. You've all heard about my girls and 8-year-old twins. And we were talking about, they saw a picture. We're talking about political leaders. And they saw a picture of Theresa May and Spurgeon, I forget her last name, the Scottish First Minister, I believe she's called. And they asked who it was, and I told them. They thought that was really cool, and I agree with them. So the Scottish voted the last time 55-45 against leaving. Things have changed substantially. The Scots also voted, I believe, over 60% to stay within the European Union during the Brexit vote. Based on those two numbers, the political analysis is that if they have a second vote, and I believe the British government Parliament has to grant permission for this. The articles I read over the weekend seem to think that the British government will, in fact, if asked, grant permission for another vote. What are they going to say? No, you can't vote? That's not very likely. So, because that would only give the nationalists a far greater argument about needing political independence for self-determination. So the question is, will those two votes, 55-45 to stay within the United Kingdom and the 62%, I believe, vote to stay within the European Union, how do those two votes reconcile in another Scottish independent vote? I don't have an answer, but if I had to make a prediction, I would say that the Scots don't leave. Now, I have no particular insight into this, but we shall see. So yet there is another year of politics. What is it that supposedly Sukarno said? And it's a novel and a great movie. It's the year of living dangerously. Well, it seems to me that Europe, and I don't want to use this in one of my columns because it's already been used several times. It's actually a novel originally by an Australian journalist about, I think the year was 1963 or 64 in Indonesia, when Sukarno, not Suharto, but Sukarno was the leader, having led the country out from under the Dutch colonial rule. It's a great movie. It's Sigourney Weaver and Mel Gibson. Very good movie. So it seems to me that for Europe, we are entering the year of living dangerously. Many things can happen this year, and I think most of them probably will. Okay, folks, I hope that's been instructive, if not enlightening, or at least informative. We will do this again next week on Monday. And I thank everyone for attending. I hope you all have a great day. And I'd like to thank Adinda, and Mauricio, and FX Street for making this possible. Thank you all. We'll see you next week. Everybody take care.